Welcome to all of you. This is A.K. Asnani from Smart VRC, Bhopal. And today's topic is find your edge and win in stocks. Yes, without having an edge, your returns will be like the other retail investors, not even equivalent to the BSE index or any benchmark index. You will be much below those indices. Why? And how to acquire that edge is what we are going to learn over here. So just a revision from the last webinar. This is what we learned regarding the comparison of various investors in any company, in any listed company. So those investors can be broadly categorized as the mutual fund investors, foreign investors, HNIs and PMS, promoters, and the retail investors. So business insights, retail investor has the least business insight. As far as the long investment period is concerned, it is only the promoters who are the longest holding investors because it is their own company and they often don't sell their stake in the company. Emotion control. Promoters have very high emotion control and they never resort to frequent buying and selling. HNIs, PMS, they also have good emotion control. Foreign investors, okay, it's not that they have very high emotion control, but of course they are very much moved by their economies. And normally, generally FIs are from US and they have very high confidence on their own economy, and they often move in and move out from the emerging economies and including India. Mutual fund, why I have crossed? They don't have emotion control because the investors in mutual fund are again the retail investors, and retail investors make an exit or make an entry at exactly the wrong times, and that is why we cannot blame the fund manager of a mutual fund. Then coming to the fees, yes, mutual fund, they charge fees. Foreign investors, they have their own research sections, and they also charge fees. PMS service providers, they also charge fees. And in case of promoters, there is no question of fees. They are themselves the promoters of the company. And retail investors, generally, they don't prefer to go with advisors in general, and they prefer free advice. So there is no question of any fees here. Outperform benchmark indices. It is only the HNIs to an extent and the promoters who are able to outperform the BSE index, and rest of the cases in general, they are not able to outperform the indices, including mutual funds and FIs. Yes, you must have observed that mutual funds and FIs, more than 90% of the cases, they act opposite to each other. When mutual funds are buying, then foreign investors are selling, and vice versa. So, and from the track record of the mutual funds, we find that hardly about 50% of the mutual funds are able to outperform the benchmark indices, hardly. And when you remove the fees part, there is the expense ratio, the performance gets affected. Herd mentality, all are a part of this herd mentality. You must have observed that mutual funds, most of the time they act in unison. Most of the mutual funds buy at the same time. Most of the mutual funds, they sell at the same time. Same is the case with foreign investors and PMS service providers. Because after all, in PMS service provider also, it is the HNI investors who are investing, and they are also affected by the herd mentality. And retail investors are the highest one to get affected by the herd mentality. Coming to the stock liquidity, mutual funds invest in highly liquid stocks. Foreign investors also invest in highly liquid stocks. HNI PMS also prefer to invest in liquid stocks. For promoters, it is don't care because they don't invest and reinvest frequently. So there is no question of any liquidity, and they are invested in their own company. So that again, hardly matters as far as the liquidity is concerned. As far as the retail investors are concerned, They are also not bothered. They invest in illiquid stocks also. They invest in liquid stocks also. So it is a kind of a don't care. Coming to the strong conviction, all have strong convictions except for the retail investors. They don't have the strong conviction because they are investing on their own. They don't have that kind of experience, that kind of wisdom, so as to generate that kind of conviction. And this conviction gets tested whenever the market falls down by 10%, 15%, or 20% or more. Then you see how retail investors exit the market. Diversified portfolio, except for the promoters, all invest in a diversified portfolios. Promoters are normally invested in a single or at the most 2 or 3 companies, not more than that. So they don't have that kind of diversification. They are investing in most of the cases in a single company, their own company, but they are highly focused. Yeah, that comes the next point. That is a focus. Yes, they are very much focused, and as you can see, except for the retail investors, all are focused. The retail investor is focused on television set, he is focused on what his friends are doing, he is focused on what his broker is advising and all those things. He is focused on where the share price is moving. While rest of the investors, they are more focused on the company rather than the share price. And as you might have expected, in terms of the returns, mutual funds and foreign investors, medium returns. HNI, that is operating through PMS, they have reasonably good returns. And promoters, they are the most gainers. Yes, be it a Wipro or be it a Reliance Industries or any company, be it a Grasim or TVS Motors, you will find that it is the promoters who have gained the most. And it is the retail investors whose returns are very, very low. In fact, the returns are negative. For most of the investors in the long term, the returns are negative. As far as the risk is concerned, mutual fund and foreign investors, they have medium risk. HNI PMS is also medium risk. Promoters have low risk because they are invested for the long term. They know what they are doing. They have strong confidence. They have strong conviction because of the long experience, because of the long association with the company. And the retail investors, they are the most highest risk takers. Now, see the risk and return profile. Retail investors take the highest risk and their returns are the lowest one. So among these 5 categories of investors, it is the retail investors who take the beating because they hardly have any edge. So the investors with the least edge are the retail investors, as we have been discussing. And the reasons are not far to seek. They have very small vision. They are looking for small returns in a sense. They are looking for 20-25% returns. There is a category of investors who sell the stocks with every 20% rise in the stock, and they look for other stocks. So they are not willing to get associated with the company story. They are not willing to get associated with the company's growth story. And they keep on churning their portfolio. They keep on selling and buying some other stocks for every 15-20% returns. Or there is a category of investors who are looking for investment for the very short time. Maybe they want to invest for only 6 months, for only 1 year, for only the period when the market is going up. That is the vision. That is a very, very short vision. And because of this vision, they think on those lines, and they are never able to not only to achieve their vision, but in most of the cases, they are incurring heavy losses. So first they have to change their vision, have a big vision. Once you have a big vision, you will look at your investments in a totally different way. It will change your thoughts. It will change your perceptions. It will change your actions. And that is what is required. So first and the foremost thing is, what is your edge? If you are looking for 20% returns from the stocks in every month or every 2 months, then do you think that you can outperform the market? There are crores of investors who are like you, who are thinking like you, and who have more information or better edge than you. Think of yourself. What is your edge? Why should market return? Why should market get you huge returns? What is special in you which is not in many others? That is what is required to succeed in stock market. So the best investor is, as we have discussed, it is the promoters who are the best investors among these 5 categories. He has the business insight, and naturally he is doing the business. He is operating the business. He has very good insights, not only about his business, but about his customers, about the sector in which he is operating. They have got very, very long investment horizon. Yes, they are invested with the company forever. Forever. Yes. Had you ever heard that Reliance is planning to exit from their company permanently? Never. Emotion control, or it is basically, yes, they have got very good emotion control. In a sense, they are not acquiring stocks frequently, neither they are selling the stocks, but at times in their business, they also get moved with the economy. During 2008, many large acquisitions were made by the Indian companies, only to later find that they made a mistake. They took huge debt, and then it became a burden for the even the parent company. So they are also emotional, but among the lot, they are less impacted by the emotions. Coming to the fees, yes, we have already covered. Outperforming benchmark indices, it is the promoters and the HNIs who are able to do it. Herd mentality, high liquidity stock, strong conviction, all these things we have already covered. Let's move ahead. So who is the best of the best investor? As I said, promoters are the best among the lot. But there is one more class who are best of the best investors. Who are those? Yes, we'll come to that. Retail investors in general, we have considered they are not performing. They are performing the least in terms of the returns, and they are carrying the highest risk. But among the retail investors, there is a class of 1% investors whom I call them as smart investors, who have a great edge compared to the all other investors, including the promoters. Yes, even they are performing better than the promoters. Why and how? That is what we are going to look in this presentation. And from where I got this data about 1%. This is from my regular seminars and workshops. Wherever I host these seminars and workshops. The very first question I ask is, who are the investors with an experience of more than 20 years? That percentage is about 2.5%. And it is not necessary that all those 2.5% investors are making great money. There are many, many investors among those 2.5% investors who are just able to survive in the market. They are not thriving. Really speaking, it is less than 1% of the investors who are really, really thriving and making huge tons of money. We are going to see what edge they have and how they have acquired and how we can acquire those edge. So this is the difference between the general investors and smart investors. So I have differentiated among the retail investors. Retail investors, there are two parts. One is the 99% of the investors are general investors, and a small portion, 1%, is the smart investors. How they are different. These smart investors have good business insights. They have long investment horizon. They have excellent control on their emotions. They are able to outperform benchmark indices not only consistently but by wide margins. Yes, they don't have herd mentality. They also watch television, but for management interviews and all those things, while a general investor watches television for the tips. They are not bothered about the advice. What they are bothered about is what are the views of the management, what the CEO is telling, what the chief financial officer wants to say. what the owners want to say about the company, about their plans, about the sector prospects. Focus on low price. General investors, yes, they are highly focused on the low price shares. They are all looking for penny stocks, stocks which are quoting at rupees 1, at rupees 5, at rupees 7, like that. They think that these are the low risk category stocks, but in reality these are the highest risk carrying category stocks. It is very simple. When the 99% of the investors think that the low priced stocks are safe, that means they are not safe. It is as simple. And the smart investors, they never care about the level of the price. They care about the worth of the price, how high the worth is and how it compares with the ruling share price. Strong conviction, yes, smart investors have very strong convictions because of their experience, because of their knowledge, because of their qualification, because of their insights into the business. Diversified portfolio, I have made it yes as well as no. Why? Yes, generally these general investors, they have a portfolio of 20 stocks or 30 stocks. So you may say that they have a good portfolio and it is a diversified portfolio. No, it is in most of the cases, I have seen that it is not a diversified portfolio. In terms of the number of stocks, yes, but in terms of the sectors, in terms of the weightage, it is not at all a truly diversified portfolio. And this thing, smart investors understand very well. Focus, as I said, general investors are focused on price. Smart investors are focused on the worth of the stock. That is a big difference. And that is very clearly evident from the returns. The returns of smart investors are very, very high, while the risk is very low. That is the difference between the general investors and the smart investors. Now, coming to the one more comparison between the promoters and the smart investors. How smart investors are even better than the promoters. Yes, there are the difference between the returns generated by the smart investors and promoters is sometimes very, very high. Smart investors are able to generate very high returns compared to promoters. How and why? So the differences are long investment period. Promoters, as I said, they cannot exit from their own company. They cannot sell the company. But for a smart investor, it is not a binding. They can sell. At a click of a button, they can sell the company and buy some other company. So if there is, suppose there is a good company which is doing reasonably well, and all of a sudden they acquire a company bigger than their own parent company, and they find some trouble. Now the promoters, they cannot make an exit. They have to try their best to make the changes in the new company to get amalgamated with the original company, the parent company, in the best way. And it takes time. Many a times it takes years. And here is a smart investor who has got an edge. He can sell that company and buy some other company. Yes, buying a stock is as good as buying a share, or buying a share is as good as buying a stock, buying a company. Emotion control, yes, both are good, equally good at emotion control. And the major difference is outperform benchmark index. Promoters in most of the good companies, yes, they are able to outperform and they are able to generate returns better than the BSE Sensex. But these smart investors are way ahead in terms of generating the returns. Why? That will come the next point. Diversified portfolio. No, promoters, they are, and in fact, it is their limitation that they have to remain invested in the company. But smart investors, they can always have a set of companies in their portfolio. So they can have 15 stocks, 20 stocks in their portfolio, and they can make changes, and they can include the best of the best 16, 17, 18 stocks in their portfolio. Same flexibility is not there with the promoters. And that is the reason why they are able to generate very, very high returns at very low risk. Yes, part of the reason of very low risk is the very long-term investment. And diversified portfolio that makes them ahead of the promoters. So it is this 1% of smart investors who are the best generating returns in the market. So what is that edge? First is look around. What is this look around? Recall the highly successful businessmen in your locality. I will give you an example. The story goes back to 1988, I think November or December. I was in BHL Hyderabad and I was transferred to BHL Bhopal. And when I came to Bhopal, I wasn't aware of a good uh, uh, hairdresser, and I was searching. One fine Sunday morning around 9 o'clock, I took my bicycle. Yes, it is the case of 1988, 89, early 89, I think. And then what I found that in the market, there was a small shop, and which was not a pakka shop, it was a kacha shop. And about 8, 9 people were standing in the queue, and shop was closed. So they were waiting for the owner to come, and it was a hairdresser shop. I was shocked. So there must be something special in this hairdresser. And then he arrived, and I also stood in the line. And after about 45, 50 minutes, my turn also came, and I was also very much impressed. And the name of that shop was Rajasthani Hairdresser. And to tell you, now he has more than 5 good shops, good quality shops, not only in Bhopal but also in nearby towns. And his name is there in the, I think, Limca. At that time, about 15 years back, his name was there in the Limca Book of Records of making the maximum number of cuttings in 3 days. So how he did it? नॉर्मली हम क्या कहते हैं कि जो नाई की दुकान होती है उसको हम उतना ग्रो करते हुए नहीं देखते हैं, बट दिस इज द केस वेयर आई फाउंड दैट हाउ ही in such a dull business, how he can create innovation, how he made value addition, how he expanded, how he talked with us, with the customers, what kind of talk he had. He visited London, he put a photograph of that. So all these things matter, how he expanded and how fast he expanded and what was his qualification. He was not qualified. So if a person like him can expand his business, can grow his business exponentially in a sector which is not known for such high growths, you can very well understand how a simple investor can create huge wealth in stock market. So I am very sure such kind of examples must be there in your locality also. And I can also recall one shop, it is still there, who always give you a very good respect and also always ask how are you, not only about you, but also about your friends, about your relatives. Yes, and that is one way of attracting the customers. Not only that, he keeps most of the things which are not of national brand, but of local brand, and not from Bhopal, but from other places, from Ahmedabad, Surat, Mumbai. So he knows the worth of the textile apparels, and that is how he is able to sell at good premium. There is another way of doing business, and I'm very sure you all must have came across such brands at the national level. Page Industries, we started with the undergarments. Here also I have a small something to tell you. I was very much impressed with the Dixie brand, Dixie, Dixcy. They are also into the undergarments business, and I was thinking, whenever this company goes for an IPO, I will definitely invest because I found a great value in their products. Meanwhile, this company Dixie, they never came to the public, but this Page Industries arrived, and I found that the cost of the product of Page Industries was about 3 times more then the best price, second product. Now, I was not convinced with the story, and I thought that this company cannot succeed with 3 times the price, and for a product for which the public is not ready to pay such a high premium. But I was proved wrong. Why? Because it was the quality of the product. It was not only the quality of the product, but also the design, the comfort, and the longevity. So if you compare all the factors, then you will find that the products made by Page Industries are way better even from the other products. Maybe individual's perception or the experience may vary, but this is what my experience is that, and this is how I missed Page Industries. Okay, you must have heard Asian Paints, how good their paints are, quality of the paints, but how many of us can buy this company share? Havells. I had a very good example. I had a very good experience how a company changed 12 fan regulators in my house, for which the warranty was over 4 years ago, and they changed it free of cost. And that made the difference in my thinking about this company. So simple example, yet so effective. I simply purchased 100 shares at that time, made good money. Presently, I don't have Havells shares, just for your information. Majestic Auto. This is a very interesting case I would like to tell you. And this is how simple thinking. I'm not telling you anything about the finance, anything related to the fundamentals. And what I am telling you is about an overview about the perception about the company. Majestic Auto. This way back, story goes to way back in 95, 96, when I saw an ad in my local Hindi newspaper that Majestic Auto company is giving 1 gold coin with their Hero Puck vehicle. Hero Puck. Okay. In those times, there was no internet, and so I searched for that magazine and found that the capital market, and then found that that company is have a negative book value. That means the negative reserves, and there is no chance of any dividend. But company is reporting positive earnings per share. At that time, the EPS was about 4, and this product was doing exceptionally well, Hero Puck. So based on that the company still it is in negative, and this from a Hero Group, and no chance of any dividend, but is giving you a gold coin. That means that is a marketing, and that means how good their product is. It is selling like hotcake. So now it is very interesting. I purchased the first share at rupees 42, and then subsequently I purchased at rupees 100 also. And then I came across an investor who was selling the share, at rupees 100, and I was buying it. That gentleman is 15 years elder to me. He called me and asked me that why you are buying the share. I told him the story. Such as such case is there, and I am willing to wait for 2-3 years, and I am very sure after 2-3 years this company will be able to report an EPS of about 10, and it will return to the dividend list, and it is a Hero Group company. So I am very sure the share price must at least double from those levels. So out of curiosity, I asked him, so why you are selling? Now see his thought process. He says that I purchased the shares at rupees 8 and I am selling at rupees 100. So I thought because he has made 12 times money, so that's why he is selling. And I asked him, he said, yes, but I am not selling completely. I am not exiting completely. I am only selling the part stake in the company. So out of curiosity, I asked him what made him to purchase at rupees 8? Because company at that time was making heavy losses and the reserves were negative. Means when the share price was rupees 8 at that time. So now see his thought process. What he said, I thought that there is a company belonging to a Hero Group. They will do something. And also at that time, there are a lot of people who are riding on bicycles. He said the day will come when these people will, means majority of these people will turn to these small scooters like Hero, these small mopeds. At that time also there was a Luna. If there are people of 50 plus, they must be remembering that brand Luna. That was a product from TVS. So this gentleman has another mentality. He was not telling me anything about the performance of the company. What he is telling is someday will come when majority of these people who are riding bicycle will turn to the mopeds. And Hero, it is a Hero Group company, they will do something so simple. So that is how the approach varies. That is how the perception varies. And let me tell you, finally the stock price went up to rupees 400. Of course, I sold it at around 300, 350 rupees. I also made good money. That gentleman also made good money, but my perception was totally different from his perception. That is how you should look at the business, at the product. Bajaj Finance, I am very sure you all must have seen that logo of Bajaj Finserv long back, but long back, I mean to say about 10 years, 15 years, 20 years back. But how many of you ever thought of that this company is spread throughout the country? This company has a backing of Bajaj Group, and at one day, this company can capture the whole market, almost the whole market. I think there are very few who purchased, who had a thought like this and purchased the shares of Bajaj Finance. Then Hdfc Bank, we all know the experience of going to a public sector bank and Hdfc Bank, and not only Hdfc Bank, from last so many years, so many decades, it is growing at 20 plus rate. But how many of us could buy, not only buy, but hold these shares? Then is the case with Pidilite. We all know Fevicol brand, and we all know that this is the number one brand. But what about the share? Did you purchase? And if yes, how long you could hold? Similarly, there are ongoing stories around you. Look around and find out what are the stories. Yes, there are stories regarding the electricity distribution. There are stories about the sewage disposal. There are stories about the passport services provided and helped by the private companies. There are stories about the credit business still going on strong, solar rooftops, and many other things. You can also find out, look around yourself, look in your house, what things are there which are in early stages. Yes. So based on such stories, based on such thought process, we come out with various stock advices in all our products. And one such report we have launched under Smart Multibagger. Smart Multibagger is one of our products, and we have launched Smart Report. And these are the brief about the stock. This was published on 3rd of March. Yes, today is 7th, just 4 days ago, this we have published. And number of stock is 1. Market capitalization, it is a large cap. Share price is below rupees 125. Target gains 102% average, and risk is medium. Holding period is pretty long. It is 5 years, 2 months more than 5 years. And quality of management is the top class. And report price is 1,000 rupees plus GST. And this report is available for sell on individual basis. And this is the way to reach to this report subscription page. On our homepage, there is a link with the name of Smart Academy and then Smart Report. So this was all about the Smart Report. Coming to the edge, the next edge is, the first edge was look around. The second is small companies. Why small companies? All blue chips of today were small companies of yesterday, isn't it? There was a time when Bajaj Finance was very small. There was a time when Pidilite was a very small company. Asian Paints, Bajaj Auto, all Lupin. I have seen the share price of Lupin around rupees 12, 13 rupees. So these are very small companies. So you have to find out which are these small companies which can be blue chips of yesterday. So you may say that how we can have an edge compared to the FIAs or mutual funds. Yes, you have an edge. You have an edge because it is not that only you know. Even foreign investors, mutual funds, HNIs, they also know that yes, there is a good company, there is going to be a blue chip of tomorrow, but they cannot purchase because of the low liquidity. They want to buy lakhs of shares, even crores of shares, and such good companies at one time they were available with a turnover with a daily traded volume of 50,000 shares or at the most 1 lakh shares. So if you find some excellent characteristic of the product or the service in such companies, buy it and hold it patiently till the liquidity increases. How the liquidity will increase? Liquidity can increase. There are many companies which are listed today only on BSE. In times to come, they may list on NSE. And on NSE, in general, the turnover is more. More investors are investing on NSE. So simply the liquidity increases. Secondly, companies may come out with bonus. Companies may come out with stock split, or even they may issue shares to the public or maybe to the promoters or maybe to the private placement. There are many, many things. Okay. So for an example, there was a time when the stock of Bajaj Auto didn't have so much of liquidity. I'm talking about 10 years ago or 15 years ago. Then company has come out with bonus as well as a stock split, and liquidity has increased by 10 times. That is how the liquidity increases. Now, these are the retail investors' edge of. We were talking about the look around, and we were also talking about the small companies. And the combination of this is the Maruti Suzuki. In July 2003, share price was 175. Today, it is 7,300. 100 times multiplication in a matter of 18 years. In a matter of 18 years. Yes. There's a Page Industries, 1100 times multiplication. And this is in a much lesser time, only 14 years. Bajaj Finance, 1740 times multiplication. It was rupees available at rupees 5 on March. In March 2009, it was available for rupees 5. Can you believe it? So there are many, many other examples. And we also, when I say we means we at Smart VRC, we also enjoy many edges, and we have as SBP, that is a Smart Billionaire Picks. This is a part of Smart Gains, our first product. And during last 20 years, as you can see the performance, how we have outperformed, not only outperformed the BSE Sensex, but we are able to increase the gap, increase the outperformance. And that is just because of the look around and the valuation also. And not necessarily the small companies, wherever we find a good valuation, we enter. And investment of rupees 1 lakh has turned to rupees 96 lakhs in little less than 20 years. That gives a CAGR of 26%. 26% CAGR for 20 years. And we are very near to 1 crore. So this journey will be from 1 lakh to 1 crore, and the show is still on. Our eyes are already set on 100 crores, billion. Yes, it may take about 15 to 20 years more, but we are moving towards 100 crores. 100 crores means 1 billion, and that is how way to a billionaire. Way to acquire edge. How to acquire edge. Okay. One is the self-investment experience. You can invest, have your own experience of failures as well as mistakes, as well as success, and learn from that. It takes very long time, very, very long time. Because as you must have seen, the major crashes happen only once in 7-8 years. And without a major crash, it is very difficult to understand the kind of risk in the market. Believe me, if you are having any advisor, ask him how many crashes you have seen. Did he see 91-92 crash? Did he see the dot-com bubble crash in 2000? Did he see the 2008 crash? Then only you can be rest assured that he understands what is risk. It is not only the returns, we have to look at the risk also. So one is the self-investment experience, and this is going to take a pretty long time, no doubt. And the other better way is to learn from the experience of other successful investors. Okay, there are very few successful investors who have authored the book. You can go for it, like Peter Lynch, and many have written about the Warren Buffett. You can even go for the interviews of Warren Buffett, Charlie Munger, and the essays written by the Warren Buffett. These are the successful, highly successful investors. What they think, what is their wisdom, how they have achieved so much of success. So that is another way of acquiring the edge. Learn from the experience of successful promoters. Yes, promoters are also investors. You learn from their experience. Look for the past annual reports of highly successful companies like the Page Industries, Bajaj Finance, and all those things. What they said, what they mentioned in their annual reports, what were their visions, how they expanded, how they diversified. You can go for the conference calls, what the management says, management discussion mentioned under annual reports. You can also look for the presentations provided by the companies, quarterly updates. All these things are available at a single place, and that is available free of cost and highly trustable. That is bscindia.com. No need to buy any other software. Everything is available in this website. I'm very sure you won't be able to take advantage even for the 20 or 30% of the matter available on BSC website. It is full of resources. Also, I would recommend a retail investor to hire an advisor and just don't go by the free tips. Hire a good advisor. Not only he advises the stocks, but through good advice, definitely you can make good money, but also he should be ready to share the logic why he has purchased, the valuation model, the valuation method he has used, and he is ready to share his wisdom. Now, this was all about whatever I said. This was all about the stocks. You need to have more edge in terms of the portfolio, in terms of the emotions. Now, in terms of the stock, we must be able to differentiate good company and good stock. Company may be good from the management point of view, but the stock valuation may not be good from the investor point of view. Similarly, company product may be good, but the share price may not be good. So you should be able to find out what is the worth, right? So you can also make an analogy with the cricket. Wait for the loose ball. You have got many years and many decades to play. You are there on the ground and you wait for the loose ball. It is not essential that every day or you have to make a call. Not required. But when you get the opportunity, grab it with both hands. And you are surrounded by large number of opponents on the ground. They are also there to win this game. You have to protect your wicket because that is the capital. The longer you stay, the more runs you can score. You get more opportunities. So your target should be to stay as long as possible. Now, market will try all types of tricks to destabilize you and to get you out of the ground. Now, it is up to you how you play the market, right? It is not, as I said, it is not essential that every time you have to stand against the market. You must know when you have to go along with the market and go against the market. You should be very clear, and that comes through experience, that comes through the edge. Another example is like flying a kite. There are different sizes of kites, and also at different levels you can fly the kite. At low levels, the kite is shaky, and similarly, the companies which are new, those companies are a little bit shaky. They are more volatile in terms of the reported earnings and the revenues. And as the company grows, as you can compare with the kite, as it goes higher up into the sky, it becomes stable, and same is the case with the companies. So there's a good analogy. The kite which gets a hole is highly unstable, whatever may be the height. Yes, if there is an issue of corporate governance, whether it is a small company or a big company, then you are into trouble. So you have to make an exit as early as possible. Yes, there is a great analogy with a film, and you must have observed that uh, these are the three films. Two of the films had great cast, very good stars, and directed by none other than Prakash Mehra, and produced by the first one by Satyendra Paul, and second one again by Prakash Mehra and Amitabh Bachchan, Jayaprada. Music was also great, but this film Sharabi, this was a super hit success, and this Jadugar equally super failure. So what made the difference? And then there is a third film wherein very few people were aware about the name of the cast, like Kamal Hassan and Rati Agnatri, and still this company was huge success. This film was huge success. So what was the difference? Difference was the story. This Sharabi had a very good story. Jadugar was lacking a good story. And again here, despite a new cast, but due to the strong story, it connected with the people and it was a huge success. The same applies to the stocks. What is the worth of the stock? What is the story? What is the story going ahead? What kind of market the company is serving? What kind of financial fundamentals company is planning to have ahead? What I mean to say is how it is going to finance the future acquisitions, future expansions. You must know the story. Without story, you won't get success. So that is what I say. First is the fundamentals that gives you a base. Then you need a good story to rise in times to come. That gives you an edge. Now coming to the portfolio, this was all about the stock. Coming to the portfolio, you have to win against Mr. Market. You are playing against Mr. Market, and you have, in chess we have about 16 pieces. Similarly, in your portfolio, you can have about 16 to 18 stocks, and each piece, as in case of chess, each piece has its own importance, and similarly, you can have a bundle of stocks, each with a certain purpose, right? And also, you can gain edge in terms of a portfolio if you consider it as a horse race. And in horse race, there are thousands of stocks, thousands of horses participating in the race, and like the thousands of stocks, and you have to pick the right horse. I mean to say the right company, and not only the right horse, but you need to have the right jockey. As in the case of a company, you need to have a good company and a good CEO. Then your win is assured. That is how you can have a perception about the stocks. Similarly, in a garden, you have to keep removing the weeds and nurturing the plants which bear flowers if you want your garden to look beautiful. And similar analogy can be applied to your portfolio, wherein you have to regularly remove the poorly performing company stocks. When I say poorly performing, I don't mean by the share price, I mean by the financial performance. If the story is deteriorating, then also it is time to make an exit so that you have only the best of the best 16 to 18 flowers in your garden. Coming to the emotions, yes, controlling emotions is the most difficult part. And consider that when you are investing, consider that you are running a long marathon race. It is not a sprint. You are not here to invest for a day. You are not here to invest for a week or a month, for a year, even for 10 years. Think that you are going to remain invested for your lifetime. Yes, that is the way to win in this market. That is the way to have an edge compared to others. The desire of more, the fear of missing out, maybe in the race others are ahead of you, and you get emotional, and so you also start running at a faster pace. No, you need to have your own pace where you are comfortable, and always think of how you can increase the pace so that you are able to reach to the destination. Stamina matters the most in case of a marathon, and the same is your patience, your perseverance in stock investing. Yes, it is boring. Those who run a marathon race, they know very well how boring it is. I am myself an example. I used to run for 2 years, 3 years at a stretch, and I know how boring it is because the same steps, same steps, same steps. You cannot bring much variation. Yes, you can increase your speed, but not abruptly. It takes time. But it is a habit. Once you get habituated to it, then there is no looking back. Coming to the emotions, yes, we must know when to dance in the rain or when to use an umbrella. As I said previously also, you must know when you have to move with the market and when you have to move against the market. What I mean to say is, when you have to be greedy and when you have to be fearful, that is not defined. Just don't go against the investors' perception. If most of the investors are fearful, that does not mean that the time has come to purchase. What decides the time is the worth of the stock. If it is available at that cheap rate, then is the time to buy. So we have discussed a lot of edges, a lot of ways to acquire the edges, and I'm very sure we all have these kind of edges, these kind of perceptions, these kind of logics in our mind, but that is under subconscious mind. You will have to awaken your subconscious mind. You have to make the connection between the subconscious mind and conscious mind. Then only you will be able to reap the benefits of the edges you have. And I'm very sure you must be able to draw an analogy with so many examples I have given. And we are also there. We means the smart VRC is always there to provide you an edge. We have the book Way to Billionaire, authored by myself, and this is a good book. As I'm not saying on my own, based on the feedback from those who purchased the book, feedback from the readers. They say it is a really wonderful book because I have not mentioned any great calculation or complex formulas. It is very easy to read. And then we have insightful videos with the name of Smart Insights Pro. Whatever I am telling you on webinars, all those things have been, and much more value-added things have been combined together. And these are small videos, about 20 minutes each. Then we conduct free seminars and webinars as you are here with us. And for creating wealth, we conduct paid workshops, and soon we are going to conduct an online workshop. And also we have advisory products. So you have to change your vision, go for a big vision, go for a smart vision, and you should not only be happy, you should go beyond that vision. I am an example. whatever I thought when I started stock market, I'm way ahead of that, way ahead. I never thought that I can quit a public sector job based on my passion of equity research. And I'm very happy and comfortable and enjoying my life. I'm enjoying my passion. It has become my hobby to share the learnings which I have made during these last 32 years. So your passion should also be very big. Enlarge your passion, enlarge your targets, keep adding edges. There is endless game in stock market. You keep on learning always and always and always. The important thing is to know what you know and know what you don't know. I hope it is very clear. You should know what you are doing, and you should also know what you are not doing, what you are not knowing. Okay, there is a small text written by Mr. Warren Buffett in a magazine published from Israel, Haaretz. It is not the strength that determines the survival of the species or even intelligence, but ability to adapt to change. Yes, that is what I'm saying. Whatever money you have or how much intelligent you are, that will not decide your success in stock market. Success will decide how you are able to change your habits for the better, how you are able to change your perception. That is very much essential. So we come to the end of this presentation. Soon after this, we are going to have question and answer session. Be ready with your questions, and you can write in your chat box, and also you can raise your hand and I will ask you to unmute yourself. Thank you very much for giving me your valuable time. And if those who have joined for the first time, let me tell you that you can join our WhatsApp groups. You must be able to see the WhatsApp number on the screen, and you can join there. And also, I request you to download our app. We are giving free IQ advice on app. What type of stocks to buy in fall and at high? There's no fixed definition. There is no fixed stocks, which stocks to be purchased when the market falls. It is up to you. And for me, how I decide is which stock provides the largest gap between the worth of the stock and the current price. That decides what I'm going to buy. And be it during a fall or even at market highs, that is the strategy we use. Okay, there is one more thing that some big investor has purchased a stake in Polyplex. What is your view? We are not moved by what other investors are doing. We have our own philosophy. So I would not like to comment on that. In workshop, which topic will conduct? Okay. Fundamentals or technicals? Okay. We are not going to cover anything about the technicals. We don't follow the technicals. Of course, I know everything about the technicals, but I have not used it from last 15-20 years, and we never use these technicals. We are purely based on the simple equation. that what is the difference between the worth of the stock and the current price. We are moved, we take the decisions based on this logic, that's all. Okay, are stock splits and bonus shares one and the same? Okay, there are different answers. As far as the money flow is concerned, it is one and the same because money does not flow. Whenever the company goes for a stock split or the company declares a bonus, it is only a paper entry. Money does not flow. In case of bonus, equity capital increases. In case of stock split, equity capital remains the same. As far as the valuation is concerned, there is no change in valuation. But what happens is due to the low price after stock split or after bonus, due to low price, more and more retail investors are attracted, and also due to the increased liquidity, many mutual funds and large investors like FIs, FPIs, they also get attracted, and that is how, due to the stock split or due to the bonus, post bonus or stock split, there we in most of the cases we get a small appreciation, not because of the valuations but because of the liquidity. Mr. Mahendra Kendra, sir. I'm not able to hear you. Yes, sir. Sorry. Hello. Yeah. Yeah. Voice is not clear. Maybe I don't know. Maybe a problem is at our end. I will request you to please write in the chat box. I will reply there, please. Mr. Ranjan Sahi.
Yeah. Hello. Can you hear me, sir?
Yes, sir.
I just want to ask you one simple question. If a stock is in the ASM list, does it really mean that it's one has to be away from it?
Sorry, sir. Kindly repeat it again.
If a stock is in the ASM list,
ASM.
Additional surveillance measures.
Yes.
That does it mean that we should not touch that stock and we should be out of it?
No, if you are a long-term investor, then it hardly makes any difference. And that is only to reduce the volatility in the ASM category. And if you are a long-term investor and the story is intact and there is nothing wrong with the company, then
right,
it's a good opportunity to buy, because most of the stocks in ASM, the speculation part is very less.
So that means in ASM, it is only the speculation which is being cultivated.
In most of the cases, yes.
Okay. Because this first source solution, I bought some shares and I found it in the ASM list.
Mm-hmm.
So that is why I am asking you this question.
Nothing to worry about it.
Okay, sir. Thank you. Thank you so much.
Welcome, sir. Okay, there is one query. Recently, we read a lot about rising bond yield in the US and its effect in stock market. What are your views on this? My views are very simple. Rising bond yield. Suppose I am holding a stock of, for example, Relaxo. Rising bond yield in US, how it will impact the performance of Relaxo? In no way. So I should not bother. As long as the worth of the stock is not getting affected, I need not have to bother. And if the people are bothered and the market falls, then, and if the share price goes below the worth of the stock, then in fact it is a good opportunity to buy rather than to sell. So be very clear. Always focus on your company. In the short term, there is going to be an impact of the market on your stocks, but in the long term, economy has hardly any role, market has hardly any role. I have given number of times, number of times the examples of Reliance Industries and Reliance Capital and Maruti, what they were at the time of 2008, the market peak, and what they are today. The difference is not because of the market, it is because of the financial performance of the company. When I have received a direct message, I would read it out because it is a direct message to me. I cannot name the investor. In my life of over 20 years in stock market, I have seen best presentation telling us how to be disciplined investor and make wealth, highlighting the various steps, comparing it with cricket, rain, chess, horse race, etc., etc. Such a nice presentation. Thanks, sir, for your guidance. Your presentation forcing me to rethink and awakening my sleeping edge again and again. Thanks a lot to you. Thank you very much, sir. Thank you. And okay, Mr. Jayanti, kindly unmute yourself.
Good afternoon, Mr. Azani, sir.
Good afternoon, sir.
How are you, sir?
I'm fine. I have changed my.
Yes, that's what I want to. Actually, very happy. You've become so smart, and your age has gone down to 20. 20 years down the line. Very happy, sir. Very happy. Looking smart. You got remembrance on my request. Very happy. Going forward, which sectors you prefer, sir?
I am not looking for any specifics. I have always looked for the good business, good story.
Okay.
Not on sectors, but in general, most of the developed countries, they are getting vaccinated at a very fast pace. And I believe in coming 3 months or 6 months, our pharma and chemical companies may get good contracts from these countries.
Okay.
Also, the companies which are into the export, they should do well. Physical export, not the IT, I am saying. They should also do good because of the
Atmanirbhar.
yeah. That is what I can tell you.
Okay. Thank you, Mr. Azani. God bless you for having rendering a valuable and a trustworthy services to the investing public. Thank you. God bless you again. Thank you. Thank you.
Okay. Do you exit the stock based on goal? Because if we are holding till the stock is intact and exit, if story deteriorates, then it will be too late. Okay. It is not like this. You get enough time to make an exit. It is not that immediately the story turns bad. You will get good opportunity to exit. I will give you an example of Yes Bank. There was a time when RBI, for the first time, it said that the NPAs reported by Yes Bank are understated. So that was the first time you got an opportunity to exit. In fact, in one of our services, if I'm not wrong, it was Smart Multibagger, we had recommended Yes Bank, and immediately on the same day when the RBI came out with this report, we made an exit. And I remember that time the share price was about rupees 300, and we made an exit. We got so many queries of why you are exiting. It is just a small statement and company will take care. I said, no, corporate in governance issue means governance issue. I cannot tolerate this. So you get enough time. So Make in India will help which sector the most? It all depends because Make in India and PLI has been announced for many sectors and there are different players in various sectors. So it depends. There may have been some advice talks which have been unsuccessful stories. You mentioned the names of successful ones only. Yes, there are, as I said, there are cases. I reported just Yes Bank. It was not an unsuccessful. I remember one MBL Infra, that was an unsuccessful story. But it cannot happen that if you are investing in say 10 stocks and all 10 are successful, even if you are successful in 6 or 7, then also you have done wonderful job. Why? I will tell you. There is always a scope for improvement. So there is always something, some edge which we are lacking, some information which we are lacking. And the wisdom lies in not waiting for the stock to fall down considerably from your buy price. So if the stock is down by 10% or 15% from your buy price, it is a very high time to look what is happening. What is happening with respect to the market? Maybe the whole market is falling, then it's okay. But if the market is stable and your stock is falling down, then it's time to think seriously. And even if then also you are not able to find out anything wrong, then it is time to make an exit. Yes, we do. Many times you won't get an answer. What to be done? Simply exit. Is it wise to exit from current provident fund accumulation approximately 8% and enter in stocks which are currently available in good attractive valuations? I would not recommend to make an exit from PF. It is always wise to remain invested in PF because that is the provident fund. That is a very safety kind of thing. And you should have a proper asset allocation in your total portfolio. In your total portfolio, my age is 54, so I have about 60% in stocks and the remaining in other assets, maybe in gold, or you can have even real estate like that. So you need to also have a part in debt, and PF is like a debt only. So that is my advice to you. Yeah, as I said, there are many stocks which keep on rising or falling just because of the movements in the market, or many times some big investor may make an exit. Suppose you are invested in a company whose traded volumes are 2 lakh shares or 3 lakh shares, and there is a mutual fund investor who wants, mutual fund manager wants to make an exit from that stock. So naturally he will sell in lakhs of shares. So at times, and not because that there is anything wrong with the company, but because he needs money to redeem to the mutual fund investors. So he is making an exit. Nothing wrong. Yes, but in the short term, share price will feel the pressure and share price may fall down. But you have to understand that this is what is happening. That is what I said. You know what you know, and you know what you don't know. So if you are very sure on the company story, on the fundamentals, and there is nothing wrong with the company, then you need not have to worry. Okay. Nita Chokkam, kindly unmute yourself. Nita Chokkam, kindly unmute yourself. Mr. Rajesh Punjabi.
So hi, good morning and thank you for your guidance as always. So just wanted to take your opinion on specialty chemical and pharmaceutical, very specifically because these are some of my personally favorite stocks. Deepak Nitrate, Newland Laboratories, and IOL Chemical. I don't know if you're following any of these three, but sir, just wanted to take your expert advice.
Presently, we don't have any of these stocks in any of our products. We have not.
Okay, sir.
And as I said, wait for at least 6 months. Let the developed economies recover fully, not fully, even up to 80% or 90%. and then you take your call, because you should not be in hurry, because companies are reporting decent performance, and I don't see any major reason for the sudden fall in the share prices. So the best strategy would be to wait for at least 6 months for pharma and specialty chemicals. Like in Aarti Industries, they have a couple of very long-term contracts. I am looking for such long-term contracts with many specialty chemical companies. But then first their economies have to come out of this COVID impact. Mr. Sandeep Singh, kindly unmute yourself.
Yeah, good afternoon, sir.
Good afternoon, sir.
Yeah, thank you so much for your valuable insights on the stock market investing. I've been following you for almost the last 2 years, and
Okay.
all your webinars, seminars, and even the workshop I have attended, and all the papers in the book are excellent. Sir, you have emphasized on the two things, the emotional control and your stomach part in your various webinars. I just want to know about the top 3 characteristics of a smart investor, apart from this emotional control, because it varies from individual to person to person. So according to you, what are the 3 major characteristics for us to become a smart investor?
At the core of the core, there is only one thing, and that is to know the fair value of the stock. If you are able to find out the fair value of the stock, then it is automatic. Over a period of time, you will get good control. I can say excellent control on your emotions, because you don't know the worth. That is why you become emotional. I will tell you one thing. Suppose we go and buy a television, and we know very well that the cost of this 40-inch television should be about 50,000 rupees. And when you go to the market and they say that with such and such specs, what you are looking for, the cost is 1 lakh. So what you will do, you know very well, because the cost should be around 50,000 rupees. Why is charging 1 lakh rupees? You will ask it. And if you are not convinced, then you are not going to buy it. Same is with the stocks. Until unless you know what is the worth, how you can be confident. And once you are not confident, then you will move with the market, move with the emotions in the market, move with the share price movement. So controlling emotions is very much required. And to control emotions, you need to have wisdom, you need to have the experience, you need to have the confidence on the stock you have purchased, and that comes from knowing the worth of the stock correctly. So the single most thing required is to know the worth of the stock. That is the ultimate thing. If you don't know the worth of the stock, then whatever returns you are making is just by chance, just because of the market movements, not because of your expertise. And the market movement returns, you know very well what happens to a general investor. For a Sensex type, you will get 14% returns. But if you move with the emotions, then you will end up losing the capital. It is very difficult. You find out around you how many are there with 20 years, 15 years experience in stock market, and you will find that the ratio is very, very small, because as I said, hardly anyone knows what is the worth of the stock. All know the price of the stock. That is what my opinion is there.
Yes, definitely. That's the most difficult thing, to know the fair value of the stock.
Yes, I agree.
And there is a very thin line between the investing and the speculating. And those who know the difference between the investing and the speculating, might know the intrinsic worth of the stock or the fair value of the stock.
See, there is no formula. I will give you one example. When we drive a car, when we drive even a two-wheeler, it is a geared one. What makes you to change the gear from gear 2 to gear 3? Can anyone write when you change the gear? No one can write. It is impossible. If I ask you to describe when you change the gear from 2 to 3, there can be n number of reasons. There can be because speed is low, because you see a very clean road ahead because many things, because you want to reach early. Many things are there, but you cannot write when means road is clean, how much clean. There is no written formula. So same applies with the stocks. There is no written formula. It is many things in your conscious mind, in your subconscious mind, which makes you to decide what is the worth of the stock.
Yeah. Thank you so much, sir.
Maybe it may vary from investors to investors.
Thank you so much, sir.
Thanks. That is very good question. Fair value keeps on changing. How often we should compare it if we are invested in the stock? See, as just now I was giving you an example of driving a car. The same thing happens in stock market. Fair value keeps on changing, but you need not have to find out the exactly how much is the fair value. So you must have a rough idea. A rough idea means approximately plus minus 5% will also do. So that is required, and fair value keeps on changing. Okay, but from the long-term perspective, it does not change very frequently. Maybe a year, maybe for 6 months, as in the case of COVID, it happened for a year. All automobile companies were closed for 3 months. So it is not going to change the fair value by a very big amount. But the share price does change, and share price were down by more than 50%. That is how you have to take advantage of that. Mr. Rajesh Babu Chokkam, kindly unmute yourself.
Mute. Good afternoon, sir. Yeah. First of all, would like to thank you very much for guiding us, small investors like us, which we in fact are creating wealth based on your advices. I have been your subscriber for the past 15 years. Okay. And yeah, now I have a fundamental doubt because see, now you are saying in the next 2 decades, the journey is towards billion, 100 crores.
Yes.
Okay,
yes.
So I have a corpus in a provident fund. Okay. So yeah, so that gives me a return of 8.5%. So I am a patient investor. I have conviction in stock markets. I have seen the two cycles of recession and all, 2008 market crashes. I'm still with the stock market. So now I get tempted to withdraw the PF, and why can't I go with the smart billionaire picks? And I mean, human beings greedy, so I can get a 26% return. So there's an alpha of 20% compared to the PF. So what advice? I mean, is it? And I'm 50 years old.
Okay.
Yeah. So.
Okay.
Yeah.
Yes. As you said, you are into the market from last more than 15 years.
Yeah.
In 2008 crash and also this COVID time.
Yeah.
Can you share what you did at this time? Means when the market crashed from 21,000 index to about 8,000, less than 8,000. What you did at that time?
I was sticking to the stocks which I had, okay. But unfortunately, because I don't have the capital, I could not invest. I know that this is going like discount and all, but I could not because I cannot have the surplus money, so I could not invest. So again, this COVID time, it was opportunity, but I could not capitalize on it. But anyway, we cannot time the market as such. You have taught in many sessions.
Yes.
So people say, like wisdom people say, you have to divide into all equities, real estate, gold and all. So my question is, when gold gives only 10% and all, when we can get 20 plus, why should again you diversify?
Yeah.
We can maximize the capital which we are having.
Yes.
So it always perplexes me. I mean, can you just guide?
Yeah, sure. If you are investing in gold only from the returns perspective, then definitely it is not a very good investment. From long-term perspective, you get about 8 to 10% returns. But there is one invisible return from gold. When you buy a gold for your spouse, she also becomes happy, and that is one additional return. So it gives not only the return, absolute return, it gives a happiness return, and it also gives you a diversification. So I would always recommend that you invest 10% of your total assets into gold. So to get rich in true manner. And also, see, I will tell you one thing. Our SBP, Smart Billionaire Picks, is growing at the rate of 26% from last little less than 20 years.
Yeah.
Now, if I am able to earn 26%, does it mean that I go to the bank and take a loan and invest in stocks? I'm able to get loan at the rate of 8%. So will it make sense to take a loan at the rate of 8% and invest in stocks and earn 26% in the long term? No. Why? Because once I take the loan, then it would be the interest on loan which will start dictating my actions. Suppose due to COVID, market is down. If the market remains down for 2 years, what will happen is I have to pay 8% and then again 8%, 16% interest to the bank for the loan. And there is no light at the end of the tunnel. It does not seems to be when the market will come back or when the share price will bounce back. So I will be very much worried about the interest part. Though I know in the long term I will be able to earn, but it is the interest on loan which will try to have an impact on my decisions. So I never go for taking a loan. Same is the case with keeping the assets diversified. If you have investment in debt, keep it there. And as you said, your age is 50 years. Definitely, you will need some money for your child's higher education, or maybe for his or her marriage, and maybe for your health issues. So you have to keep certain amount always separate. Emergency fund, you can say, and it is a provident fund. So again, I would not recommend you to invest that money in stocks.
Okay.
That is my
Thank
honest
you.
opinion.
Yeah, sir. So one more doubt, sir. So this one of the I don't want to name the company name. It was like in your weekly thing, you are asked to target achieved. The same time you again purchased in the SBP pick.
See, there are two in smart gains. There are two parts. One is the pick of the week, and the second is smart billionaire picks.
Yeah.
Pick of the week is for short term. That varies from 6 months to 2 years or maybe 18 months. And smart billionaire picks is we are running from last more than 19 years, almost 20 years, and so we are there for long term. In pick of the week, we get an opportunity for short term. So there are two categories of investors. There are investors who don't want to invest for long term, who don't want to be part of the smart billionaire picks.
Okay.
So they are very happy with 15% or 20% returns, and they want to switch over to some other stocks because we advise about 52 stocks in a year. So they are very happy with that. And those who are willing to remain invested for long term, they can follow the smart billionaire picks. So if there is a case wherein there are the same stock is there in pick of the week and also in smart billionaire picks, and if we are exiting, if our target is achieved in pick of the week, and if you wish to remain invested for long term, then you can remain invested and follow the smart billionaire picks. It is like this. Of course, both are separate. And if we are holding in smart billionaire picks, definitely the future is bright. But maybe we may have to wait for maybe 1 year or 2 years to reap better gains. It is like this.
Thank you very much, sir. Thank you very much.
Welcome. So with this, we have come to the end. Already 1 hour and 34 minutes. It was a pretty long session, and enjoy your food. Thanks for being with us here. Thank you for your support. Thank you very much. Bye.